In a surprise move this morning, the Monetary Authority of Singapore further tightened its monetary policy to help strengthen the dollar and keep inflation down. MAS raising slightly the slope or rate of appreciation of its Singapore dollar policy band. A stronger currency lowers the cost of imports, which Singapore is highly dependent on. The move comes a day after data showed inflation climbing to 4% in December, the highest in nearly 9 years. Let's bring in UOB economist Barnabas Gan. Barnabas, MAS's monetary policy stance is typically announced every 6 months in April and October. An unusual off-cycle move today. Could you expound on the significance of it?
Hi, thank you for having me on the show. I think what's important to note really is that the last off-cycle meeting that was done by the MAS was on the 30th of March 2020, and back then it was really in response to the lower than expected core inflation amidst the COVID-19 pandemic. I think what is important to note is that the off-cycle meeting that has happened, it's really likely in response to the higher than expected inflation pressures that has been seen in Singapore. Do note that December's inflation is at 4%, headline inflation is at 4%, while core inflation has actually passed its 2% handle in December last year.
And today's announcement, Barnabas, is the second round of tightening in 3 months. Do you reckon it will be enough to keep inflation in check?
Well, I guess that it's important to note that there is upside risk to inflation given the impact of most of the pandemic-related and geopolitical shocks on the global supply chains, at least for the year ahead. And really, for the first half of 2022, what we do expect is that it's for headline inflation for Singapore to actually stay above the 3% handle, before easing to the 2% range towards the end of this year. And this basically suggests that inflation pressures will likely stay above trend, at least in the first half of this year. Although core inflation is still expected to stay above the 2% handle for the whole of 2022. But I think what's important to note is that headline inflation is likely to actually decelerate into the second half, and what we do look for really is for headline inflation to actually average at 3% for 2022. So this basically means that the off-cycle, also the off-cycle decision by the MAS to actually tighten monetary policy today will likely be really in response to the higher inflation, and that would mean that they are trying to keep the inflation pressures in check, at least for the later half of this year.
That said, Barnabas, help us to understand why is it important to keep inflation in check and not let it skyrocket or go too high up?
Well, I guess that really from the economics point of view, some level of inflation is necessary when it comes to the running of the economy. But a runaway inflation, or from how you put it, a skyrocket inflation, it's really detrimental to the inflation, to the economy, simply because it does actually deteriorate or more so ruin consumer spending power given inflation. So basically it means that the $1 today may actually be valued way lesser compared if inflation is allowed to run uncontrolled. So this is really very much a mandate of central banks, not only in Singapore, but I believe across the world, to actually keep and avoid skyrocketing inflation for their own respective economies.
Barnabas, always a pleasure to have you on the show. Economist at UOB, Barnabas Gan.